Just when the market thought that mortgage interest rates were finally under 7%, mortgage interest rates skyrocket once again on jobs numbers, which are completely horse manure. And we have interest rates well over 7% once again. And while I'm at it, happy Monday from Real Estate Mindset. You guys may be wondering, why am I doing a morning broadcast this early? And it's because I'm leaving. Don't judge me, you guys, okay? This is 10 years in the making. 10 years in the making. I'm leaving again as soon as I'm done with this broadcast for a 3-day trip for Great Hammerheads. I'm trying to document the world's largest Great Hammerhead, so I'm going to do that. But don't worry, you guys. I have stacked some amazing videos for you guys when I'm gone. It's only 3 days. I got some, again, I think it's going to be some really good reports on eviction, foreclosure, layoffs, bankruptcy, market cycles, all of that type of stuff. And I also wanted you guys to know, for the first time since 2021, your boy put another offer in. I'm sorry, I put in 2 offers. Okay. So for the first time since 2021, I put offers on more than one house. So I put an offer in. This is so messed up. All right. I'm going to tell you guys this and we'll move on. But I put an offer in. Good morning to everyone. Well, real quick. Good morning, Scrog. What's up, man? I miss you, bro. He got a house in my market. He didn't even use me as a realtor, probably because I said I'm not going to represent anyone. Good morning, Matt. Good morning. Good morning. Good morning. Maverick, what are you doing up so early, Maverick? Why are you guys up so early? I thought no one would be online right now. Good morning, guys. Good morning. You guys, you mean so much to me. There's my man. You guys mean so much to me. So much to me. I can't do this without you and your support and your love. You guys, there's so much hate in the world. It's so overwhelming. You guys keep me going. Understand that. But I put an offer in on a house last night. Okay. All right. Listen very carefully to what I'm about to tell you. Okay. I put an offer in on a house. All right. But let me explain the parameters, because people are like, oh, I thought the market's going to crash. Why are you putting it in a house? Because I found a house where the price crashed to 2021 levels. I put an offer in on a house that, again, had prices of 2020. It had 35% in equity. I would be paying $150 less than what I'm paying now in rent. I could cash flow $600, you guys, $600 a month. And my move-in cost, $4,000. Why is my move-in cost only $4,000? Because I use my realtor commission as my down payment. And if I have 35% equity, I'm just going to put the minimum down on a loan. Why would I put 20% down? To avoid PMI? Yeah, maybe. But maybe I'm just going to refinance in the future. I don't care. 3 years from now, it doesn't matter. But you guys, this was a solid deal. $200 cheaper than rent. $95,000 in wedge or 35% in equity. All these great things, right? We would have to put in sweat equity. And here's the thing. I'm texting the realtor the whole time because I don't want to do all the paperwork, because, again, the house was already listed at 2021 values, but I came in at $32,000 under listing, but I didn't want to waste my time. So I'm texting the realtor the whole time like, hey, can I send you a verbal offer, right? I didn't tell her I was a client yet. And yeah, everything's going fine. Finally put the offer together, and out of nowhere, you guys, me and my wife are already looking at like vinyl and laminate floor because it's a sweat equity thing. It's built in the 1970s. It has green carpet. The place had green carpet. That's what I'm looking at. It's not a turnkey. So it would have been a family project where my wife and children and I would have actually redone that entire house. It would have been really fun for us. But in the middle of, you guys, out of nowhere, I think someone's spying on me. I don't know how else to explain this, because out of nowhere in the 11th hour, right when we had kind of just wrapped everything up, an all cash offer came in over my offer and took the house. The house had been sitting on the market for almost 60 days. Almost 60 days. And the day I put in an offer, some all cash offer comes in and destroys me. It's still not time. The housing market's still not time. Now, obviously, I'm in Houston, so my market's a lot softer than a lot of other places in the nation, you guys. But I'm, right? It's depressing, a little bit depressing. It hurts every single time, but I'm not giving up, and I'm not going to settle. And I am always prepared to walk away. Every time I make an offer, I'll walk away. And if I have to wait another year or 2 years, I'm going to wait another year or 2 years, and I'm going to love my family. I'm going to be a great husband, as great as I could be, and a great father, as great as I could be in the meantime. And I'm going to love my life, but I am not going to use my emotion to buy real estate like the whole market wants us to. And the good thing is, and I forgot to put the slide up, you guys, prices are going down. Prices are going down right now overall in the housing market. Not in every metro area, but we have Black Knight data. Again, value, not talking median. They keep manipulating median, but we have indexes from Black Knight that are saying overall, many different metros, price decline. Why are prices declining right now? Probably because inventory is exploding, right? Where's all the bulls with the supply and demand narrative? It's shifted. Now they don't want to talk about it. But the thing is, again, I'm going to show you guys 6 states according to Fred, and that's lagging data. I'm not even using Redfin. I'm going to show you guys 6 states that have more inventory than pre-pandemic, okay? Good stuff. All right, let's get started right now. Sorry for the rambling. I just had to tell you guys the offer. I mean, it's hard out there, man. Still not time, and I'm in Houston. Houston, again, I got a lot of opportunity out here, and it's just still, it's very close, you guys, but it's just still not time. Let me start by the economic calendar. Let me move this for you guys real quick. So this is an extremely big week because on a lot of stuff happening on Wednesday. Okay, pretty much nothing happening today. You guys can see that here. Not a lot happening on Tuesday, but come Wednesday, we got a lot of stuff coming out. We got CPI coming out and the interest rate decision on Wednesday. So CPI and interest rate decision on Wednesday, and on Thursday, PPI. So remember, guys, this week, remember in the back of your heads, follow up on the market on Wednesday and Thursday and see what's going on with the inflation battle, because that's some big information coming out this week, day after day. So that's pretty interesting. Now, let me show you guys where interest rates, mortgage interest rates. Remember, you guys, the federal funds rate does not directly impact mortgage rates, although it influences them. We want to look at the 10-year. But regardless, here's what mortgage rates are sitting at. We briefly got under 7%. The market was like, oh my gosh, let's go out and buy. And then they strangled the housing market once again, and interest rates are again well over 7%. And that 10-year, you guys, the 10-year is up today. I didn't have it on my screen, but the 10-year is up today about 3 basis points. I'll try to pull that up on our next video. But right now we're sitting at conventional. This first column, remember, you guys, is conventional, sitting at 7.15%. Now, as usual, you guys know this by now. You guys are experts. As usual, FHA is lower. FHA is sitting at 6.64. Now, if you're listening to me, you've got good credit. You don't have no consumer debt. You've been working on your purchasing power. You have not been using your emotions to buy things. You should get listen to me, this is no science, okay? There's no science to this. But if you're listening to me, you should get probably, I'm not a financial advisor either, okay, about a half a point lower than what you see here. And in fact, I actually confirmed that because before I put the offer in last night, I called the loan officer I was working with and said, please give me an updated pre-qualification letter. You guys, I've been pre-qualified for 2.5 years. I'm always pre-qualified. The reason I'm always pre-qualified is if I find a house that is under market value, that is a great deal, a home that I love, I'm going to go get it. So I'm always pre-qualified, always. So I called her, and my interest rate for an FHA, I got conventional, I got FHA, but for FHA, it was 6.125, and for conventional, it was 6.875. So it was about 40 basis points lower. And again, you guys, that was with a broker. And also, what's interesting is today, 15-year is lower than FHA, so it's a little bit abnormal. But take a look at what the market is anticipating. Now, first of all, it's probably going to be elevated for this whole home buying season. Thank God. That's exactly what we wanted. That's exactly what we were hoping for the last year. We got it, and now what's happening? Okay, we got the high interest rates and the 7%. Now what's happening in the housing market? Well, the balance is coming back. Is it back yet? No, it's taking time. But what has happened? Inventory explosion. Inventory explosion, and I really feel bad for all the 10 million homeowners who just bought at the peak, expecting to refinance and expecting their home values to continue to go up. There's 10, 15 million people that got bamboozled. Now, some of those recent buyers did well. Look at Jeff M. He did well. Look at Raymond. He did well. Look at Scrog. He did well. So there are people that are doing well, but most people are not. Almost like, I would say, look at the buyer's remorse survey, 93%. Buyer's remorse survey. I mean, there's a reason why people regret buying houses. Ask yourself that question. Why are they regretting what they're doing? Probably because of unaffordability, right? The price and the payment and the interest rate, triple whammy, and they got to settle because there was no inventory. Take a look at what the market that is completely foolish is anticipating as far as interest rate movement. I'm only going to waste your time by looking at December. This is never right, but this is CME Fed Watch. If you just want a talking point at a party and say, oh, guys, look at CME Fed Watch, this is what's going to happen next. But no, that it never goes down the way they think. Ever, never, ever. But regardless, The market is saying no rate cut, okay, because I like looking at December. So I'll go all the way to the end of the year to see what the market is anticipating. They're saying this is, I believe this is the highest this has been. So the market is tightening down their expectations, although the stock market is still flourishing, which to me means there's going to be a crash in the stock market, although I'm not in stocks. But right now, 14.1% likelihood, no rate cut. So the market's saying, which by the way, doesn't know anything, market's saying 14% chance rate cut. Okay. More than likely, most of the market's right here with one rate cut. And then we have two rate cuts right here. So they're saying more than likely one rate cut, possibly two rate cuts. And when I say rate cut, 25 basis points. But what they keep leaving out of the equation is they're not going to significantly cut interest rates unless they have to stimulate the economy. Do you guys agree with that? Or can you explain to me, if you're on the other side of the coin, why would they cut interest rates if they don't need to stimulate the economy? Why would they cut interest rates for? Because if we have a great economy, then we should thrive with high interest rates, even though these are average interest rates. They're not even high. They are high for the last 20 years, though. Last 15 years, though. I'll say that. But regardless, here's CME Fed Watch, completely nonsense. Now, here's where I really want you guys to pay attention as consumers. You guys should be getting this by now. This is an amortization schedule. This is what traps you in your home forever. Okay, this is what traps you in debt. In fact, this is almost as worse as credit card debt. I didn't say worse. I said almost as worse. And the reason is this sucker, this again, the way that the payments are made, the amortization schedule or payment schedule is front loaded with massive amounts of interest. It should be illegal. So I put 324,000 loan amount. Today's interest rates of 7.15%. That's conventional. Remember, FHA is lower. Total amount of interest paid back is $463K. Total amount of payments is $786,000 on 324,000, making it a bad time to well, here's the thing. When people say, oh, you're renting, you're wasting 100% of your money. Okay, fine. If you buy right now at 7.15%, you're using 140% of your money. At least if I'm renting, 100% is wasted. Here it's 140%, although there are tax benefits as well, and you pay your loan down. So it's not just a slam dunk. Owning a home is good. Generally, it's just we have a problem right now in the housing market, and we need to push time out and stop buying overpriced houses. The sooner that people start using fundamentals to buy houses, the sooner that realtors tell clients, no, slow down. Let me show you how to find a great deal. As sooner all that stuff happens, sooner we'll come back to balance. And the less people will have to get hurt right now, because the bubble just got deflated and then it's get bigger, depending on the market. All that means is more of our citizens, more of our neighbors, more of our peers are going to get hurt. Remember, guys, in order for us to win, people get hurt. That's the thing that really sucks about all this. We don't want the corporations, the greedy, the elite, whatever. But us, you and I, we don't want us to get hurt. We want us all to grow together so we can get ahead together. Because look at all the people that are against us. Everyone out there wants to make money from us. So we got to work together. This is my opinion, of course. All right, guys. So that is our mortgage update. Boom, 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 boom. Oh, I wanted to show you guys one more thing, actually. This is important. Back to the amortization schedule. Okay, take a look at this. Now, I highlighted this because I wanted to show you guys. All right, so you see the loan balance is $320,000. So you start with a loan balance of $324,000. Now, after the first year, you get that loan balance only down to $328,02. That's a difference of $3,200, which means if you want to save this first year of interest, this $23,000 of interest right here that I'm circling, okay, all you have to do is pay $3,200 down on your principal. Now, obviously, the later on in your amortization, that benefit shrinks, but the first year, massive benefit. So you pay $3,200 of your own money, you get the money back, and you save $23,000. So I'd like to challenge you guys, for when you get a tax return, put half of that bad boy. If you already own a home or you're going to own a home in the future, put half of your tax return down on the principal on your mortgage and start saving $20,000. Attack the amortization schedule. To put this in perspective, first year you pay $23,000. The 29th year in interest, all you pay is $2,700. That is how front-loaded heavy these amortization schedules are. Big issue, you guys. Again, don't be imprisoned by that. And don't just think you should just keep refinancing. Remember, if you refinance, you have to start that bad boy all over again, and you start getting the banks rich all over again. And we don't want you to do that. So we're going to listen to our first video right now, you guys, where there's a little bit of light at the end of the tunnel. Let me ask you guys something. What do you think the light is at the end of the tunnel? So we'll listen to this again, but what's the light at the end of the tunnel? And this is from realtor.com. So what's the light at the end of the tunnel? Do you guys know? Where are the fishing video? Brother, that's why I'm going back. I didn't get a giant hammerhead last time. But if you want to know where the fishing video is at, I do have another YouTube channel. I make zero money on that. I got to be a little bit of an artist. You guys know I love cinema. I love drone. I love that. I want to go outside and do videos. I don't want to do videos inside. But it's called Spartan Tackle Fishing. If you want to see my fishing videos, Spartan Tackle Fishing. Again, it's just like I do that for me. So there's some crazy music. Okay. Just forgive me if you go there. Anyways. All right, guys, we're going to go into our first one. Good morning, man. It's nice to see you, OSO. All right, guys, we're going to go into our first video, light at the end of the tunnel, but I wanted to see if you guys knew what they were going to say. What do you think they're going to say the light at the end of the tunnel is? What do you guys think they're going to think it's going to be interest rates going down? Probably not. Come on, guys. What are they going to say is improving in the housing market? We need a shark fishing and okay. Okay. No way, Nikki. I ain't paragliding. Never paragliding. I don't ever want to paraglide. Or parasail for that matter, but I will shark fish in a kayak at night. That is not the light at the end of the tunnel, Nemo. Don't shoot. You look at the profile picture. Don't shoot. What's the light at the end of the tunnel? Light at the end of the tunnel. Red. No. Red. They may go bankrupt. That's not the light at the end of the tunnel, guys. What is happening in the house? You guys have been following me for like 2 years. What's happening right now? What's the light at the end of the tunnel that's happening right now? Johnny can drive a boat? No, that's not. Commissions? Boom. Commissions, maybe, but okay. P-Nice, you got it, buddy. Yeah. P-Nice gets it. Good job, P-Nice. There we go. Another one got it. Dingle, JJ, Blue Sky. There is massive inventory due to people losing their jobs and can't make payments and the unaffordability. Prices are going down as well, but it's the inventory, you guys. Inventory is exploding. Don't miss that. Remember, the bull's narrative for the price sustain it and increasing is the laws of supply and demand. So look what's happening. It's reversing. Do you hear the bulls talking about the laws of supply and demand anymore? Do you? I don't hear them talking about that anymore because it's that pendulum is swinging the other way. And so now it's our turn, but we got to be patient. We got to be working on our purchasing power. There's a little bit of a hyperinflation situation going on. I get all that, guys, but enjoy the video. And please let me know that the audio is okay.
Continue this conversation with Realtor.com Chief Economist Danielle Hale. Danielle, you just heard it there, right? Housing affordability, Gen Z's top voting issue. Is there light at the end of the tunnel, though, for this generation?
Yeah, I absolutely think so. But it is a really challenging place for first-time home buyers right now, young people who don't have a home but aspire to be homeowners one day. Rents are high, home prices are high, mortgage rates are high. It's expensive whether you're choosing to rent or whether you're trying to buy a home. And there's really no escaping these costs, I guess, unless you are able to live with mom and dad, which is not everyone's first choice. So it really is an important issue. And it's no surprise that young people are paying attention. It is for many the number one issue.
Danielle, there's a certain segment of the population that is renting, and they're saying actually owning a home, having that American dream is slipping out of reach. And therefore, I'm probably going to end up being a forever renter. I'm not talking about myself here. But there are people who feel that way, and that's because there hasn't been enough supply in the housing market to bring prices down the way they should come down when mortgage rates go up the way they've shot up. So when do we get that balance back?
Yeah, builders are working on it. They have been building at the upper end of their recent range. We build roughly 1.4 to 1.5 million homes every year, and builders have been trying to maintain that pace, but they've had some challenges between lot availability, labor availability, and making sure that they can have the buyer demand to sell profitably. They've been doing some interesting things like trying to build smaller homes, but it's a pretty big problem to build out of. Realtor.com estimates that over the last decade, we are short about 2.5 million homes on the low end, could be up to almost 7 million homes. And given that 1.5 million pace per year, even if we just tried to close the gap, we're looking at a multi-year problem. So it's going to take a while to build enough homes to fill in that deficit while we're also keeping up with the new young household.
We have 15 million vacant homes right now. Just put this in perspective to what she's saying. 15 million vacant homes
that are able to launch and get out there and need a place to live.
All right, I need a bright spot, Danielle, because this is a lot of depressing news. The number of homes for sale is slowly starting to recover, is it not?
Yes, that's right. So Realtor.com tracks the number of homes on the market every month. And in May, the number of homes that were for sale was up 35% compared to a year ago. So even though we're still down relative to before the pandemic, there aren't as many homes. There are more than we saw a year ago. We're slowly climbing out of this hole. And there are more in the most affordable price tiers. So under the median price point, which is good for those entry-level shoppers. Homes are still expensive, but there are more of them on the market, and that should help to break through some of the logjam for entry-level buyers.
Uh-oh, that's not good, huh? Now, the thing is, guys, I'm gonna keep telling you this over and over. We're gonna go into our real estate update. I'm gonna show you guys massive inventory, but I mean, we got to be careful how we're buying. I mean, that's what I've been saying this whole time. I'm gonna take some questions real quick. Boom, boom. Dang, House Hacker, you're awake, bro? What time is it? It's 4:30. House Hacker's in San Diego. House Hacker, what are you doing up right now, bro? It's not even light out where this guy's at. I love how, I like House Hacker, good morning, brother. Let me see. He's a veteran. I always, man, I really love our veterans. I really respect. I really wish as America we took better care of our veterans. This is what House Hacker, and again, I respect him. I bought my first prop in June 2009, my first property 2009 for $175,000 with a 6.75 during crash. I refied 2012 to get down to, oh my gosh, 2.75 on a 15-year using a VA refinance. That's the IRRL, the IRL is a refinance from VA. And I believe there's sometimes you could streamline that at no cost. Yeah, at no cost and save $450 I used to pay. So in other words, look at what it took for House Hacker to refinance, right? He didn't just refinance from a 6.75 simply to a 5.75. A lot of people are like, if I could get my interest rate down 1 point, it's automatically worth refinancing. No, it's not. You got to look at the whole picture. And again, look at House Hacker. He went from 6.75 all the way down to 2.75. That's how you refinance. He saved 4% on his interest rate, and he did that in 3 years. And he turned it from, so if he paid it for 3 years, it was now a 27-year loan because he paid it for 3 years. But look he cut his amortization down to 15 years as well. That is how you refinance. If you're going to refinance, get not just a little bit lower rate, get a much lower interest rate. And as long as you can afford it, right, House Hacker, as long as you can afford it, reduce your amortization schedule, guys, because I just showed you how bad that is. House Hacker, thank you, brother, for sharing your insights. Couple more comments, and I'm going to go into the real estate stuff. This was really good. This was a comment from Deerfield Disc Golf. What rate do you believe is a fair interest rate? Honestly, 4.3% seems like a happy medium. I'm going to tell you guys right now, I don't care. I don't care what interest rates are. I've never cared about interest rates, to be honest with you, except for that I want them to go up. What I care about, Deerfield, is the price, right? The interest rate is the interest rate. It's the what do I think is a fair price? 30% lower. Can I just talk about price? 30% lower, maybe across the field, 30% lower. But as far as interest rates, Deerfield, to be honest with you, I don't think we should never go under 5%. I think that if kind of what you're saying, not right now, though, not right now, but listen, the specificity, when we have balance back in the housing market, so we have price correction, okay, and we have inventory, 5%. I think rates should stay in the 5%. I believe they will stay in the 5%. We're kind of in this situation partially because rates were so low. Remember that the high rates is designed to fix this. The low rates is what got us here. Obviously, the lockdowns and things like that as well. But that's what I would say. Here's one from Nemo right here. Problem, a lot of inventory needed, updated or have deferred maintenance. And I want you guys to think what he's saying. That's why new builds are so popular, because a lot of these existing homes, they're falling apart. In fact, the offer that I made on the house had green carpet. It had green carpet. The house is old. That's how I was able to get wedged. But see, the thing is, I'm not a first-time homeowner. I have the right expectations. So what do I expect when buying an old house? I expect sweat equity. So if we would have got that house, my wife and I, we're weird like this. Raymond does this as well. Raymond's in our Discord. He's a big member. But my wife and I want to fix things. That's what we love to do as a family. Like, we'll put in flooring. We were excited. We were going to go on YouTube and like learn how to do all this. I mean, that excites us as a family. So you got to be aware of that though, because when I walked it, there was foundation issues. There was roof issues. I mean, I got into the attic. Are you guys? When you're walking past, you get in that attic. I have a flashlight. I'm looking at the roof. I saw damage in the attic. I saw damage in the foundation. You guys, it could be very, very expensive purchasing a home, but more importantly, maintaining it. So be very cautious and understand it costs money to be a homeowner. Good comment. I got one more and then we'll get started on the real estate stuff. Let me prep that real estate stuff. So the last comment, then we'll start. The Laws of Music says, check Houston inventory last week. There's major corporations offloading the inventory like crazy. That's one reason why prices are going down and inventory went up with what feels like overnight. And that would explain a little bit as well in Florida. Florida is a huge, maybe the biggest speculation state. And so again, that would account for the trajectory, the speculation. And remember why part of the reason, not the entire reason, part of the reason for the great financial crisis was the overwhelming speculation. So people would just hold houses, right? And then they're like, oh, we don't want any part of this, let's sell. And all these people wanted to sell and liquidate. That created comps under market value. 3 comps, you're out. So 3 bad comps in a subdivision can wreck the entire neighborhood. That's it. 3 comps, you're out. All right, guys, let's move on to our next thing here. I appreciate you guys. We're going to go into the real estate stuff right now. I'm going to try to be quick because I have to leave here shortly. All right, so we're going to go into the real estate stuff. Take a look at this, you guys. This is inventory. Let me move this out of the way. Thanks again, House Hacker, for participating, man. You know, House Hacker, I know you're listening to me. You know I like the best in you, man. You know I like to see you shine. You know that, House Hacker. I've never even met you. I feel like we have a relationship. I like to see the best of you, House Hacker. I mean, you're a veteran, man. I beat you up a little bit. I beat you up because you can handle it. And I don't want you picking on people. I want people to learn from you because you have this skill, right? So I want to see the best in you, brother. Here's housing inventory. This just updated June 4th. I mean, oh, okay. This is for Texas. I wish this was national average. So I'm going to show you guys 6 states. Okay, so 6 states with literally skyrocketing inventory, starting with Texas. And you see, Texas is insane. So Texas, we're at 101. And look at, guys, we have to go all the way back to October of 2019 to meet this. But what I want you guys to understand is we may have inventory increases up all the way into November. This is just to May. This is just to May. The inventory increases have just begun. So how much higher is this going to go? Think about what I'm saying. It's just May. It's going to go up at least June, July, and August, probably September, October as well. It's just going to keep going up. That's Texas. Texas is blowing the door off the hinges with inventory. I mean, and not only that, this is just existing. We also have the most new homes in the nation. Things are changing, man. All right, here's Florida. I mean, can you see it? Can you guys see it? Right? Where are the bulls talking about the laws of supply and demand? Do you remember how they used to, being a YouTube content creator, they bashed me like crazy, guys. They're like, you're stupid. It's simple. You learn in elementary school laws of supply and demand. Well, they didn't learn income in school. They didn't learn how to pay your bills. They didn't learn how it takes money to pay bills. And if you don't make enough money, the law of galactic law of fundamentals says you can't make your bill payments if you don't have the money. And that's what I'm like, you guys. And also, we're not in a vacuum. Inventory was bound to go up. Everyone's like, this is going to last forever. No, it's not. It's going to take some time. It took a little bit more time than I personally wanted. I blame that on the bank term funding program. But look at the trajectory. All those people that were buying right in this whole little era right here, like 2021 to right here, these are the people that are really at risk. All these people over here, not so much at risk. They refinanced low rates. They got 100,000 in equity, although they are at risk, but these are the people that are at risk. Look at the inventory. Absolutely skyrocketing. In fact, let's see the last time Florida had 137,000 units. Okay, so let's go back here to right here. So the last time they had this was June 2019. Florida is just a beast right now. I cannot believe the trajectory is now exceeding Texas. I can't believe that. Texas was on a roll, but Florida came out of nowhere. And look at that trajectory. I mean, seriously, guys, that's shocking, right? If you just recently bought a house, I'm not laughing at you. What I'm saying is like, tighten up, right? Make sure you can keep your job. Let's look at the next state. Look at that. Arizona, that's the state number 3. Look at, okay, so we got 24,000 units in Arizona. Last time we had that prior to lockdowns was May of 2019. Now you may be saying, Travis, they already hit more inventory than they have right now. Yeah, you're right. But that was in September, you guys. Back in May of 2022, when we had deflation in the housing market, back in May of 2022, we only had 11,000. We have double. 2 times more inventory right now. Because look at what happened in May of 2022. Look at inventory kept going up. You see that? All years, inventory kept going up in 2022. What do you guys think is happening right now? And I'm saying that this is going to continue because of price cuts and days on market. Those 2 things alone. Days on market and price cuts. This is going to keep going up. Let's look at the 4th state. Colorado. Welcome, Colorado. Finally, my God. Colorado also has more inventory than pre-pandemic. Did you know that? Or right before lockdowns. So we're sitting at 18,400. Let's see the last time we had that. December of 2019. So barely there. But again, the trajectory. And again, you may be saying, oh, we've had that much before. Well, not in May. Look at May of 2023. They had 13,245. We have 18,447. And the trajectory is skyrocketing. Odds are we're going to go up 2 more tiers. Odds are, I'm telling you guys, these 6 states that I'm showing you, it's probably going to reach the 10-year decade average this year. 10-year decade average for inventory this year. But unfortunately for the recent homeowners, those prices aren't average. Those prices are way ballooned. It's bubbled. Here's number 5, guys, Idaho. Okay, so Idaho's sitting at 6,481. Last time we had that pre-lockdowns was November of 2019. Okay. Keep your eyes on, keep your eyes there. May of 2023, we had 5,591. So we have more. So keep your eyes on Idaho. It's making a lot of progress. Some states, though, they're in real bad shape. I'm just showing you guys the states that the inventory is absolutely skyrocketing. Look at this. You can see it clearly here in Tennessee. This is for Trey. Where you at, Trey? Where's my buddy Trey? I don't see Trey. I'm hurt that Trey's not here. Trey's in Tennessee. Tennessee now has more inventory than they did pre-pandemic. And look at the trajectory. Again, where's the bulls at? So we have 21,948. Last time we had that was December of 2019. Okay. But look at the trajectory. Inventory really starts going up in May, like April, May. So we've just begun, you guys. We should have massive amounts of more inventory, at least going to September, possibly November, but at least September. This is insane. You guys starting to see what's going on? Now, remember, here's what matters. Everything we're looking at is macro data. What is this? Okay, what am I looking at, guys? I want you to tell me, okay? Because I need you guys to start talking to your realtors. I didn't say buy a house. So I need you guys to start accessing this. What is this that I'm looking at? I need to break this down for you guys. I need to know that you guys understand this. Okay, what is this I'm looking at here? This isn't Fred economic data. This isn't Redfin. What is this, guys? What is this on the screen here? What do you see? What is this? What is this, guys? Come on. I'm not moving forward until someone gets this right. What am I looking at? What is the software? I'm always saying this is the best software. This is what you need access to. What is this, guys? What is this right here? Come on, guys. What is it? No one knows what this is. Come on, guys. I know. Maybe no. You guys are probably just listening. You don't have your phones in front of you. But someone type in what this is. Thank you. P Nice is on a roll. There you guys are. I see you. Okay, I got you guys. I think there's a lag or something because now everyone. Okay, yeah. Okay, I'm sorry. No, it's MLS. Okay. This is a multiple listing service. This is why you need, one of the reasons why you need realtors. This is showing you this is showing you properties for sale. But what's important, guys, is not the properties for sale. What's important is the comps. Okay. Who is the owner here? Open Door. This is an Open Door property. Look at that. So I just happen to click on an open. So Open Door's in Texas. You got Open Door's flipping like crazy. But they're also pulling down comp values because look at, they just had a price cut. So this is an Open Door property. But what I wanted to show you is, again, the comps. So remember, I talk about subdivision review. So if I'm interested in this property, I got to figure out what the subdivision is. And the subdivision is Woodland Pines. Okay, so again, in order for me to determine what's going on in the places that I want to buy, I have to put only the subdivision in and look at sold properties. So this, I mean, it's very, very easy to do this, guys. And sold property, what's another name for sold properties? What's another name for sold properties, guys? Let me get some answers down there. Okay, what's another name for sold properties? What's another name? I'm watching you guys. Yeah, you got the subdivision analysis. You know subdivision analysis. You're very good. You're very good. Come on. What's another name for a sold property? I think there's a little bit of lag. Closed. What's another name? Kind of comparable. Yes, Scrog. So we want to look at comparables. Comparables of properties that have sold. So again, good job, guys. Again, I only want to look at sold properties right here. So I check off only sold properties. This is everything with MLS. This is the only thing I care about on MLS, to be honest with you. Also archive. I like the archive as well. So I'm putting Woodland Pines and I can put the last year and I can see the results. All right. Now you see this here, these, what you're looking at, you guys, these are comps. These are actual comps. So what this tells me here is over the last year in Woodland Pines, there were 33 homes that sold. And so if I want to do a subdivision analysis, I am basically adding all this together and then dividing by the number of units to calculate average. Now, if I want to, usually what I'll do as well, guys, is I'll organize this by size. Because remember, when I'm doing an analysis for a subdivision, I am doing it within a threshold or a variance of 500 square feet, which means if my subject property or the property that I want to buy, if it's 2,000 square feet, that means that I'm only using comps 1,500 square feet and above, or 2,500 square feet and below. So there's a 500 square foot variance. If you do that, you will get better results in your analysis. So I would check all these, but I would uncheck the small ones, right? And then I would also uncheck the really, really big ones. And then I would just add everything together, divide, and I would get my average. You can do this on Zillow in disclosure states as well, because Zillow and Redfin both have comps. But again, you guys, you need comps. Once you get this number, the $128 a square foot, you're in business. And also don't forget, you guys, obviously I have put together a subdivision analysis form that I made for you for free. I hope you like it. All right, we're going to go into our next video right now, video number 2, which is prices are going down. I don't know if you guys knew that or not, but prices are going down of homes. Slowly. Still not time to buy overall, unfortunately, but prices are going down again. Here, take a listen to this video. Let me know the audio is okay. And happy Monday again if you're just joining. I love you. I want you to do well. Enjoy.
It was a blowout jobs report from May. The U.S. added 272,000 jobs. That was well ahead of the 190,000 consensus. Meanwhile, the unemployment rate did rise to 4%. So did this jobs report throw cold water on hopes of a summer rate cut? Well, joining us now is Jeremy Siegel, professor at Wharton School. Professor, it's great to have you on this show. And that is very much where I wanted to start, because the headline number was very strong. The wages data was very strong, but we did see unemployment tick higher. And there were some signs of, I'll call it bifurcation, when you looked under the hood in this report. Is the thesis around the Fed not cutting and holding steady through the summer still intact?
Well, Morgan, one thing that I think is noteworthy about today's action is how many times have we seen the 10-year go up 12 basis points, which is quite a big rise, and stocks held their own. Normally, that bigger rise would really depress stocks. I think it was sort of a relief. You have to remember that we were getting some very weak data late last week and early this week. It looked like the economy was sliding. In fact, the Atlanta GDP now was below 2%. At the beginning of the quarter, they had actually thought this second quarter was going to be over 4. So there was some fear. Oh my goodness, we're slipping, could be into recession. I think with this employment report and the ISM report that we got a couple of days ago, there's a sort of a sigh of relief. And actually, I saw that Atlanta now is actually above 3% again for their estimate of this quarter. So what we have is the economy is holding in. You're right; it's mixed. Household was down. The establishment survey was up. There was a little. I think one of the reasons yields rose. And this addresses your question about what the Fed is going to do. The wages were hotter than expected. But we have to remember that there's an important wedge between wages and inflation, and that's productivity growth. So we can't just translate, this wage means this inflation, because the productivity moves upward. And we did not have good productivity in the first quarter, but oftentimes it bounces back. This 4%, 4.1% wage growth is not at all threatening for inflation. And I actually think we're going to get good inflation news in the second half of this year.
It's interesting to hear you talk about the productivity wedge there, because what's new and what's different about this cycle, arguably, is the implementation of AI. We don't always talk about it from a macro or economic standpoint, but I wonder if that is factoring in here, particularly when you do put forward a thesis about, say, a soft landing.
Yeah, absolutely. I mean, I believe that AI is going to be very important for economic growth. Now, a lot of economists are saying, is it yet? A lot of people are talking about more 2025, 2026. Goldman Sachs and others say that it could increase real GDP growth between 75 and 150 basis points for up to a decade. That's huge growth going forward. So it is certainly probably, I think only about 8 or 9% of firms have really implemented AI programs yet, but we're on that cusp. And don't forget stocks. Stocks are a forward-looking asset. The market's forward-looking. So even though the productivity might be trickling in slowly now, I think there's encouragement about what's going to happen in the coming years.
Okay, so even as yields have ticked higher, at least in trading today, can stocks continue to move higher as well?
Oh, yeah. We're still, we had gone down 30 basis points. We kind of took a third of that away. And again, when we talk about yields going down, people say, that's good for stocks. Well, there's two types of yields going down. If it's because of a weakness in the economy, that's not good for stocks. If it's because of slowing inflation, that's great for stocks. So as we all know, the Fed next week, it's it's going to be a very fascinating week, because we know the CPI comes on the day that Fed is going to give their announcement on Wednesday. I believe that Chairman Powell will have that data actually on Tuesday afternoon and can incorporate it in that. But I'm expecting, as many other economists are, that the data is going to get much better in the second half, particularly because we know that the housing statistics that the Fed uses and government are lagged, and that housing prices have not, and rental prices are not going up now at the rate that they report. Insurance rates are stabilizing. Those should appear in the second half of this year and bring inflation down much closer to the Fed target.
Okie dokie. If you say so, I don't agree necessarily. All right, so a couple comments, and I'm going to show you guys a new leading indicator of a recession that is it's I didn't realize this at the time, but it seems it's more accurate than the yield curve inversion. Again, it's crazy, but I wanted to throw this up real quick, you guys. This is a good comment by Edward right here. He said unemployment rate is now 4% before revisions. It's rising, and what do you think it's going to do in the incoming recession? We know every single recession, and they changed the definition, it has led to skyrocketing unemployment. And that's why people get so freaked out with regard to unemployment, because it is uncontrollable. And that's why the Fed cuts rates to stimulate the economy so that the unemployment stops. But I don't know what it's going to get to, Edward, because I don't trust any of the numbers. They're not calculating it the same way. I just know it's going to be bad for a lot of people. And then this is a really good comment from Nikki. Employment is a lagging indicator of recession. And that's exactly what I'm going to show you guys right now. Let me just real quick, if I may, I'm going to throw up. Oh, I just lost it. Oh, well. All right. I'm going to go into liquidity and recession right now. Okay. Take a look, guys. I want you guys to look at this indicator. This is huge. This is a bigger indicator than the yield curve inversion, in my opinion. I went back to the 1960s. So I went back to 1961, you guys, and I looked at the trajectory of unemployment. All right. And here's what I found. First of all, okay, you can see unemployment is going up. Do y'all see that? See how unemployment's going up? You kind of see that right below my face. Unemployment's going up. This is for sure. It took a long time for the Fed to break the market, but they are slowly doing it. Unemployment's going up. Unemployment hasn't gone up in 15 years. And going back to 1961, the only time, okay, going back to 1960s, the only time that unemployment went up was when we were going into recession or leaving recession. Do y'all hear me? Going back to the 1960s, the only time, look at employment's going down. And then when it goes up into recession, look at employment's going down the whole time. When it starts going up into recession, second recession, look, employment's going down this whole time, going down, 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 down. Only time it starts going up, boom, recession. Okay, through the recession. See that? Boom, unemployment goes down the whole time. It only goes up into recession. Do you see this? Look at that. Going down, 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 only going up into recession. Do you see this? Unemployment only goes up when we're about to enter recession. This may be the strongest indicator of recession that we have so far. Again, you can go back a century, half a century. Unemployment, go and look for yourself. Look at U3 and U6. Track this, guys. Look at this data. All right, I was shocked that no one else is talking about this. And I was talking to Jack with Nobody Special Finance over the weekend. He was going over the job numbers, and I was like, man, I just noticed like unemployment never goes up. Like unemployment, literally, go back here. It never goes up, guys. Unemployment only goes up when we are about to enter recession or we're leaving one. Tell me a time that I'm wrong, going back to the 60s. Tell me a time that I'm wrong in the last 50 years of what I just said. This may be the strongest indicator of recession right now. Unemployment's going up. Y'all feel me on that? Y'all understand? Okay, unemployment is going up. Now, here's another indicator. Okay, a lot of people are like, this is the single best indicator of recession because it takes a whole bunch of stuff and it puts it into one trackable data set, which is the inversion of the 10 and the 2. And we are still pretty inverted. You guys, we're at 44 basis point inverted. So we've been stuck here since what, about October of 2023? We're stuck here. We're just waiting for the collapse now. That to me, that's what that looks like. Like the smart money and the scared money, and these people on the sideline, they're waiting for the collapse. Look at this. Now, as they continue to wait, their purchasing power is getting crushed as well. I mean, everyone's purchasing power is getting crushed right now. But here's another indicator right here of a horrible economy: the deficit spending. The deficit spending right now is $855 billion, and that is as of April. So we're just in April, and we're already at 855, and this is after tax revenue. So this is already baked in most of the tax revenue received, and we are still we're close to $1 trillion. When this updates in a few days, I can't believe it's not updated already, to be honest with you. But when this updates in a few days, I think it's going to be over $1 trillion. Let me know what you guys think, but I think it's going to be over $1 trillion when it updates. All right, now here's another thing, guys. The overnight reverse repo, it's starting to lose some steam again. We've been stuck here. This is the suspension system of the economy. It's been at a horrible, horrible plateau ever since about February. It's down to about $395 billion. This is kind of like excess money. Okay, so it's excess money, but maybe it's starting to go down again. It's hard to say that there's a trend, but there's still a lot of money in the system. Now take a look at M2. M2 is telling us how much money is in the system. Now, M2 has been going up arguably since October of 2023. Do y'all see that? That's why I don't necessarily think that there's going to call a recession in October. Maybe they will, but it's because there's so much money and a lot of money came back. Oh my God, that's going to fall. Please don't fall. Oh, it fell. Oh my God, it just fell down. Oh my God, just fall. Okay, it just fell. The astronaut just fell. All right, anyway, so, I mean, it's been going up. since October of 2023. Now, recently, okay, as of April, I don't understand what's going on behind the scenes, these greedy politicians. But as of April, we had a massive decline in M2. Y'all see that? Followed by a slight increase. So once this updates next, I think this is going to show a downward trajectory. It's hard. Why did it go up again in October? Does anyone have an answer other than deficit spending? Does anyone know why M2 went up around October of 2023 other than deficit spending? Is there another reason why this went up? My point is, though, guys, is it's starting to go down again, but there's still inflation. There's still a lot of inflation actually in the system, and that is worrisome. You guys see that astronaut's gone? He launched off to space. Only he went through the bottom of the earth to go to the other side. So we're going to listen to our last video. And this video is actually from Charles Payne. This is a pretty good video. And he's going to basically say, don't give up hope. Okay, so this is a don't give up hope video. This is where we're going to end. I really appreciate you guys for joining me. And here is our last video.
We hear it all the time. The top issues for voters this election, immigration. No, it's crime. No, it's abortion. But what is the biggest concern for younger Americans?
Okay, so I'm just checking. We're all unable to buy a house right now, right? Like, I'm not the only one who runs the numbers every single day and looks at the budget and is just like, there is no way on earth that this is potentially feasible for me.
We were sold this unachievable dream that if you work hard, you get what you want. It seems like no matter how many hours you put in, you're getting nowhere.
We bought our house in 2018, and if we were to buy it today in 2024, we wouldn't be able to afford it. So our monthly payment in 2018 was $2,894. Today, that would be $6,776.
Wow, if you didn't get a fixed rate. Now, with soaring interest rates, low inventory, how do you buy your first home in this impossible market? That is the American dream, or should we change it? Joining us right now to offer solutions and analyze the problem, the best in the business, the host of Making Money on Fox, Mrs. Charles Payne. Charles, you've heard this before, right?
Sure, of course.
You got emerging teens, too. What do you say to these people that are concerned?
The last guy was humble bragging a little bit, though, right? His house doubled in value. Yeah, I like what he did there. The young lady was interesting because she's like, I'm working hard. Yeah, I'm looking at her age. She's in her 20s, right? It's unrealistic. It's always been unrealistic to be able to buy a house at this age. So I think first and foremost, do not give up on it as an American dream. They really have done some terrible things with respect to flooding the economy with so much money, sparking 40-year high inflation that does not go away. Also, because the Federal Reserve has gotten involved, you've got this whole thing that's so skewed. People who've locked in rates are reluctant to sell. You're not going to sell a house, even if you made big money on it with a 2% mortgage and trade it in for a 7% mortgage, right? So you don't have a lot of sellers. There's no incentive for builders. A couple of things, the taxes, the bureaucracy. It's just really, really crazy. It's really, really tough. Let me give you a stat. This stat is going to blow your mind because we have the most unaffordable housing market in the history of America and in the world. If you wanted to make our housing market affordable, you could do one of three things. Housing prices would have to come down 41%. Incomes on average would have to go up 69%, or mortgage rates on average would have to come down 4.3%. Instead of over 7%, like about 3.5%.
Which it was not too long ago.
Not too long ago. So the last one is the only one that can happen. And the only way that interest rates are going to come down that low is the economy's got to go into a deep recession. So my advice to people is there's a couple things. We're in this new age, work from home. So the beautiful thing is you don't have to necessarily be in an overpriced city to get these great jobs and be able to work. Consider working further away.
From the city.
From the city, getting more land, getting a bigger house for a smaller payment. Consider that. Also, everyone just has to buckle down. Right now, you really have to make sacrifices. You know, I spoke to a bunch of police recruits a couple of weeks ago, and I said, you got to give some of these things up. You know, you can't have an OnlyFans account, an Uber account, a Grubhub account. You can't go out for avocado toast every morning. You just simply can't have it all. And nobody ever could have it all. Right? I mean, I saved up for a long time to buy my house.
So get yourself on a budget. In the little things matter. It gets to be a mindset.
Save that cash so that when the circumstances change, when the tables change, and we do come into a recession and housing prices plummet and mortgage rates plummet, you'll be in control.
And it could happen soon. 1981, the average person who got their first house, 29. In 2013, it was 31. In 2023, it was 35. So that's what's frustrating some people.
Sure.
I want to bring up something new and forward-looking. could the stock market be going to Texas? It looks like they're going to be launching a Texas stock market with the help of BlackRock and Citadel in 2026.
Wow.
How real is this?
It's very, very real. You know what was ironic? The same week the same couple of days that this news came out, New York dropped its congestion pricing scheme. Okay.
Which charged everyone just to drive through the city.
To drive through the city. Extra. You already paid a ton of money if you came from New Jersey, right, on tolls. And, of course, the parking is crazy. And so it's so ironic that the governor said, well, let's hold off on the congestion pricing thing. They're chasing businesses out of America, out of New York City.
These are the major companies. And if they're getting tired of New York, don't you think other people will follow?
Of course, because these are also companies that are trying to attract the top talent out there, the smartest people out there. The smartest people out there have choices. When you graduate from your school and you're the top of your class, you may not want to go to a crowded city that's extraordinarily expensive and work,
back to our first topic.
Right, in a crime-ridden city, right? So they have to make these adjustments just like every other business. That's why businesses have fled en masse from California and New York. Huge. I mean, just, you've seen the numbers, how much it costs to rent a U-Haul leaving New York as opposed to one going to New York, right?
Right.
It's expensive because everybody wants one.
So I think we should keep our eye on that and see what's happening. Also, I see that fewer and fewer companies are going public and they're keeping it private. They just don't want the scrutiny. They don't want other people looking over their shoulders.
It's two things. The going public became a scam in my mind. Over the last 20 years, Silicon Valley and Wall Street have ripped the American people off by on back of the envelope $1 trillion. This is my personal opinion. Because what used to happen is 25 years ago, a company would go public at $30 a share. Later on that day, it'd be trading at $60 a share. And everyone would say, look at all the money you left on the table. You could have sucked that up too. And now they stay private and they keep raising money privately. They start with friends and family, then a first round, then a mezzanine round, then another round. And every time they raise money privately, they hike the value of the company. It doesn't matter how much they're making.
Right.
So a company could be worth $5 billion. They hike it to $40 billion, and then they go public at $80 billion. The public gets caught on to that, and they're not playing chumps anymore. So if you want to go public at a reasonable price because no one should be buying these IPOs.
This is why Charles is the best. Charles, thank you.
All right, you guys, that is Charles. I like listening to Charles. Some really great points about rebudgeting, don't lose hope. Be patient, do work, things like that. But that's going to end it, y'all. I'm going to get out of here. I have a 7-hour drive ahead of me that I got to make in about half an hour. Again, I stacked some videos for you guys. I'm going to be on the beach. I'm a little excited. I'm going to try to make some videos while I'm on the beach so I can give you guys kind of a behind the scenes on what I do as a hobby. Because it helps me a lot function. But, I wanted to remind you guys, you're very important. You're very appreciated. You're doing great work out there. Continue to do great work. Continue to rebudget. Empower yourself. Happy freaking Monday. Don't use your emotions. Love people. And if you're out there investing in real estate, you guys already know, I wish you luck and I hope you win.